This week on the podcast, we're going to talk about the 5 biggest risks to a retirement plan. So let's get into it with the brothers. Here we go, right here on the podcast. Hey, everybody, welcome into Retirement Approved with Matt and Steve Paul. Thanks for hanging out with us as we talk investing, finance, and retirement with Matt and Steve. And we're going to get into a conversation, a little illustration today about some things that could derail and mess up your retirement plan. And we don't want that to happen. So we're going to try to highlight a few things. We got some slides for Matt to share with us this week, as always. So what's going on, fellas? How you doing, Matt?
Good. Had a great 4th of July. Had a party on my lake. My little girl learned what fireworks were. So she's been up over the last few weeks as people have been lighting them off, but
Nice.
She was a trooper. She made it to what, like 11:30? She loved those fireworks.
Nice. How old is she?
She's 3.5, so she fell asleep literally watching the fireworks in my lap.
Nice. That's hey, 11 o'clock at 3.5. That's pretty good. So I'm with you there. How you doing, Steve?
Good. We joined them for the 4th, took the kids over. They swam all day, hot dogs, burgers. It was a great 4th of July. They got in the car, went to leave. Within 5 minutes, all 3 of them were sleeping. So, they had a great day.
Oh, yeah. We usually get invaded by some family every year here at my house, and the kids swim in the pool and so on and so forth. And I have that 3-day rule with guests. After 3 days, just like fish, it starts to stink. You got to go. So after the 3rd day, love y'all, but get out, right? and then unfortunately, somebody else showed up at the end of that, and they're like, and I'm like, well, we already hit the 3-day rule, and they're like, yeah, but that was for those people. It gets to reset, and I'm like, no, that is not how this works. I don't want more people at the house. But hopefully everybody had a good holiday.
Yeah,
that's right. Hopefully everybody had a good holiday. We're a little bit later into the month at this point. We're having this conversation, but we want to get into some conversation on these 5 big risks, guys. So I'm going to let you guys start to take this away here in a second. Let's kick it off. Where are we going to go here? What's risk number 1?
Yep. Number 1 is sequence of returns. And that is a fancy way of saying luck of the draw. So how lucky are you going to get on market returns early in your retirement? So what we have is a scenario here. It's the 2 brothers is what we always like to compare it. 2 brothers, 2 retirements. So the brothers' names are Matt and Steve. So I'm the younger brother. I get to retire a little bit early or later in 2010. Steve retires earlier in 2000 with the same exact parameters. We each have $500,000. We both need $30,000 per year in income. And we want to see how that looks with all other variables staying the same, just one different factor, and that's the market returns that you get. So what I did is I told AI to age us to retirement age, see what we look like. And then Steve, I'll let you run through your retirement. How did you do?
What do we got?
What
here?
is this?
That's
spooky. Oh, I don't like that at all.
That is not
surprise me with that.
Steve, you don't look happy in this picture.
Yeah. I don't. Yeah, look at those returns.
Okay. All right.
It looks like happened? I finally started coloring my beard there too. All right.
Nice. So what happened? Why are you unhappy in this picture?
So this is a bit of an eye opener. We always go over this with clients. So many people come in and it's making that mental transition from I've been growing my money all these years to I now need to start spending some of this money to fund my retirement. People think, well, S&P is going to go up, it's going to go down, market's going to go up, it's going to go down. I'll have some good years and I'll have some bad years. But then we put this in front of them and say, well, what if you have those bad years up front? What if you have 2 or 3 bad years right up front? What does that do to your portfolio? And then we stress test it and we give them an idea of what that does. And that's usually a problem that we need to fix. So nobody likes conservative investments in a year where the market goes up and you don't see the same returns as the S&P or tech. I understand that. But if you have those bad years up front, you're going to want those conservative vehicles in the portfolio to move you through years like that.
I got you. So what happens is obviously, again, back to Matt's conversation about this being the luck of the draw, is you retire and unfortunately the first couple of years are down or a bad market. It has some pretty cataclysmic and kind of cascading effect on the overall portfolio then.
Yeah. And you look at those and those are your golden years of retirement. So clients aren't coming in and saying, I don't want to spend that much up front. They're going, no, I'm 65 years old. I'm finally retiring. 65 to 75, that's when I'd really like to spend the most. Can we tier it off where I'm spending more in those years, and then we slowly start to pull less because we're just not doing as much in maybe our late 70s, early 80s. So really, when someone comes in, we look at the core. We talk about the core of the portfolio all the time on this show. How do we move through years like this? Let's say we have 3 great years up front. We could pivot, maybe take some more risk. The numbers look a lot better. But whenever we're building an income plan in retirement, we need to look at worst case scenario. And this is worst case scenario.
And then really, I'll take the best case scenario in that case, and that's retiring in 2010. So retiring in
Okay, so we're
2000, I
gonna.
wouldn't
Oh wait,
necessarily
wait,
Oh
wish
wait,
my
on.
wait,
God,
wait,
Matt,
wait, wait.
pause,
Hold on
pause.
a second. What in the world is this? Get
Yes,
some
spend
sun,
all of your
please.
money up front because you are not living very long going off of this picture. What has happened to you?
So AI was not kind to me, but the market was. So you can see my
Take some of these
500,000.
profits and go get a personal trainer ASAP,
Please,
Matt.
please, yeah. Go on vacation, get a little sun. Uh, man, looks.
So I stayed inside, managed my portfolio, grew my 500,000 to 875,000, and that's in 2019. And then we know 2020 through now has been a great market as well. So that's just luck of the draw for you. If you're taking market risk, you don't know what you're going to get. More than likely, somewhere in between 2000 and 2010, you're not going to get 2 recessions, more than likely, and you're probably not going to retire into a 15-year bull market.
Right.
So that's
Yeah.
just where we want to eliminate luck of the draw. We don't want it to be based on luck. We don't want your retirement to be based on luck. We want it to be based on math, and that's where you need to reduce that risk, especially early on in retirement when you're relying on it for a healthy portion of your
Yeah,
income.
that's why you need to identify your income goals. So start tracking your budget. What is your income target going to be upfront in retirement? And then what are your guaranteed sources? Social Security, do you have a pension? On top of that, what are you going to need? We have some clients that have 6 grand a month coming in from Social Security and pensions, and their expenses are 6 grand. They're able to take more risk with their assets. We have some clients that say, hey, we've got 5 grand coming in from Soch and our expenses are 9 grand. We need our portfolio to generate 4 grand up front. And then on top of that, we'd like to spend another couple grand a month on vacations in those early years of retirement. So we need to make sure that we're hitting those goals and we protected enough of the portfolio to do that if we have those down years.
Okay.
Yeah.
So when when you're talking about luck of the draw, Matt, I know a lot of people are kind of maybe listening and going, "Well, how in the world do I avoid luck of the draw?" Right. So this again is
Mhm.
where kind of structuring out a proper portfolio is hopefully hedging against these possibilities, right?
Right. And that's exactly right. And the reason we put this first is this is the number one risk people are exposed to right now because we've had a phenomenal market. Bonds have done nothing over the last 5 years, literally a negative return over 5 years. So people have either not rebalanced, so they've let their 60-40 portfolio drift to now a 70-30, 80-20, or they're just saying, hey, you know what? Bonds have done nothing. I'm going to throw it all in the market, let it ride. And that's where people are very overexposed to this risk as they're entering retirement right now. So it's critical to take some risk off the table, whether that's through fixed income, annuities, buffer ETFs. Who the heck knows? There's plenty of ways to structure it. It's just making sure you're not overexposed.
All right. So that was the first one. So sequence of return risks. So what's risk number 2, Steve?
So then we come into longevity risks. So we talk about the sequence of returns up front. We need this money to last. How long do we need it to last for? We don't know. People are living well into their 90s now. It's no longer strange to do that. So, if you take a big hit up front, if you're still going after market returns, you take a big hit up front, what do you bring into play? Longevity risk on the back end now. You're probably still going to be fine for those first 10, 15 years, but what if your retirement is 25, 30, 35 years? We need to make sure that we can fund it on the back end. So longevity risk is coming into play more and more often now with these longer retirements, more advancements in medical technology. People are living longer now, so we need to plan for it.
Yeah, you got to have that in play because God willing, you're going to have this longer retirement and you're going to enjoy yourself, right? At least you hope
Mhm.
you would anyway.
When you hear from a lot of people going, well, I want to spend more money up front. That's fine on all the fun stuff. And then I'm not
Hmm.
going to spend as much. Well, Matt talked about it in the beginning. It's called the spending smile. You're going to spend more up front on all the things that you've been putting off, all the things you want to do. And then in the middle there, you're going to have a little bit of a wall where you just don't spend on a heck of a lot. You're getting a little bit older. You know, when you go out to a movie, you're going to go see a movie at 1 o'clock in the afternoon, get those cheap prices. Your dinner's going to be at 4 o'clock. You're going to get that senior special, and you're just not spending as much. Then on the back end, they pick up because those healthcare costs.
Yeah, and it's wild to
Gotcha.
think
Okay.
if you retire at 60, you could easily be retired for longer than you were working. So if you retire at 60, that you live to 100, that's 40 years of retirement that your nest egg needs to plan for. And a lot of people think, okay, my golden years, my first 5, 10 years, we're going to do all the travel, we're going to do all the fun, and we'll start slowing down and spending. But that's where on the
Right.
back end it's going to pick up in terms of health costs. Now, not necessarily for everyone, you're not going to have those health costs, but it could be there's going to be a wide variance. Some people are going to be burdened by it, by having to go
Sure. Yeah.
long-term care and paying, who knows, 8, 9, 10 grand a month, or some people might not have any of that cost. You don't know what it's going to be, so we definitely need to make sure that's planned for. But we'll talk about that a little bit more in risk number 4.
Okay. Well, so we'll get to 4 in a minute. So that was risk number 2. So longevity, and get some ideas there on how to deal with that particular risk. So risk number 3 is what?
Inflation. So inflation from 2010 to 2020 wasn't much of a concern. So if we throw up the inflation chart that we have here, we can see 2012 1.7, 2013 1.5. We just had very low sub 2 inflation for over a decade, and people kind of forgot about it. It wasn't much of a concern until, guess what happened? Ukraine invades Russia, COVID, all that spending, and now you see inflation. 2021, we saw 7, then 6.5, now 3.5, and it's just been a wild ride for inflation. It's hurt a lot of people, but now we're getting down, hopefully closer to that 2% Fed target. I don't know if they'll get there anytime soon, but that's the overall goal. But you can see the 110-year average is over 3, and the 10-year average is close to 3. So you could probably use 2.8, 3 to factor that into your retirement plan.
It's improving slowly, but it's improving. You have to factor it into a plan. So we see a lot of do-it-yourselfer plans, and they factor in maybe a 0.5%. You got to go up closer to 2.5%. You look at the grocery store, you see all those videos on Twitter now where they're posting them going, this was my exact same order 3 years ago. I just
Right.
put it in. It's over double the cost now.
Yeah. Oh,
So
yeah.
it's out there. We're going to have periods where, like we just went through, where inflation is just off the charts high. So you have to factor it into a retirement plan moving forward.
All right. So, did you have anything you wanted to add on inflation there, Matt?
Yeah, how to address it in your portfolio, and that's just making sure your assets are growing at more than 3%, more than the rate of inflation, so you're not losing purchasing power. And how do you do that? Well, you don't sit in cash. Now, right now, cash is paying 5%. We're very fortunate that rates are
Sure.
there,
Yeah.
but it's not going to
Yeah.
be there in a year. It's not going to be there probably in a few months. We're going to see rates start ticking down, and now if you're earning 4 or 5% on your cash, maybe next year you're earning 3 to 4, and then in another year we're back in that 1 to 3% range on your cash, and now you're
Yeah.
losing to inflation. So we want to make sure you're not overfunding your emergency account and sitting there losing purchasing power. And how do you do that? Well, let's get in it invested in stocks, bonds, ETFs, mutual funds, annuities, anything that's going to get it working and earning more than that 2 to 3%.
Yeah, and these are for the folks that have 30-40% of their assets, just sitting in cash, and they have money in their walls and in Folger tins. We don't. That's what we're talking about. And Matt talked about stocks. A lot of people, I don't want to own them. I'm not comfortable with the risk. There's tools out there, vehicles out there that we can use to still keep up with inflation, bringing on minimal to no risk. So you want to look at some alternatives if you're that type of investor.
Yeah. So, do you guys remember that show Arrested Development? It used to be
Oh yeah.
on. And there was the line you talked about in the walls. There was the line where I guess the dad kept telling the son, "There's always they're broke," and the dad keeps telling the son, "There's always money in the banana stand. There's always money in the banana stand." And the kid thinks he's talking about just working the stand, having the stand be a business. But the thing anyway, long and the short of it, burns down. Right, and he's like, "You idiot! There was literally money in the walls of the banana stand." So,
Yeah.
it doesn't really work that way, right? You can't just go reaching into your walls and pulling out, out money unless you're, doing some crazy stuff there. All right. So that was the inflation risk. What's number 4, guys?
Long-term care risk, healthcare risk. We all know that's something that can happen, and it's more than likely than a fire or using your homeowner's insurance. Having long-term care insurance is a critical part, but the problem is it's crazy expensive, especially if you haven't purchased it and now you're approaching retirement and you're in your 60s. That's a difficult bill to stomach if you're looking to buy long-term care insurance at that point. So there's a couple different ways to cover it. And Steve, I'll let you kind of dive into that.
Yeah, right now, I mean, plans are just outrageously expensive. In a lot of cases, if you don't use it, you lose a portion of it. If you were lucky enough to get a long-term care plan, 15, 20 years ago, you may have something incredible that we cannot recreate at this time. But you look at, some other options we talked about, income generation upfront, core of the portfolio. A lot of our clients don't need all of their assets geared toward income, all of their portfolio geared toward income. So we're able to take a piece of it and put it off to the side and grow it long term. And maybe we do some Roth converting. Maybe it's just a non-qualified account where we're owning individual positions and just letting it ride and continue to roll up for 15, 20, 25 years. That could be kind of titled wealth transfer. Eventually it goes to your kids. But before that, it could be a long-term care bucket to maybe pair with a healthcare rider that's attached to an annuity. So maybe you retain some of the risk in that bucket, and then you transfer some of the risk to an insurance company, and you add a long-term care rider to an annuity. So there's different ways to go about this without spending so much money on a long-term care plan. But it is tricky, and it needs to be planned for.
I'll just run through it. There's 4 primary ways to cover this cost. The first one Steve talked about was self-insuring. Then the second is just plain old long-term care insurance. Third one is adding a feature to an existing product. So if you're getting an income annuity or a life insurance product, something that can enhance the benefits there. And then number 4 is actually trust planning. And that's something we're going to dive a little bit deeper in on an episode with an estate planner, probably within the next few episodes here.
Okay.
So
Yeah.
those
That'd
are
be
the
great.
4 ways to address it. And it's something that you do not want to leave unaddressed, because that can be a $2, $3, $400,000 expense pretty easily, especially for a married couple.
And one thing to consider too, and when you're thinking about long-term care, let's say you spend down on the portfolio. A lot of people, well, I still have enough income coming in to live, even if we spend down our entire portfolio to zero. Keep in mind, you lose a social security check too if your spouse passes away. So you spend a portfolio down and then you lose a social security check. Maybe you don't have the income now to hit your income needs after your spouse passes away. So really make sure you do a deep dive and take a look at that.
Yeah, and think about the healthcare situation for many people. If you are a married couple, a lot of times people fear is that one person has a long-term care event, and then that winds up depleting the nest egg, and now then they pass away, and then the second person, the spouse, is now left with really no retirement, right? Because it's just been completely drained. So obviously having a strategy and a plan in place is the idea, so that we can try to avoid that or minimize those catastrophic effects as much as possible. All right, final one, risk number 5. Who's taking this one? Matt, you taking this one?
Yeah, sure. So tax risk. And we all know that we're in a favorable tax environment right now in terms of history of the United States. And we all know that we're a little bit in debt. So there's probably only one place for taxes to go at this point, and that's up. And the problem with baby boomers is most of their wealth is tied up in 401ks and IRAs, maybe a pension that's taxable as well. You don't have a lot in that after-tax bucket. So whether that's an after-tax brokerage account or a Roth IRA. So the risk is that taxes go up in the future and we're going to be paying more in taxes. And how can we address that? That's through Roth conversions and making sure your asset allocation is set up in a tax efficient manner.
Just to add to that, so let's say you don't use up the pre-tax money and you pass it to your kids. Typically you're passing it on to your children in their highest earning years. So maybe you could have done some Roth converting. We talked about this on one of the, I think the show we did about a month ago. Maybe you can pay 12 Fed or 22, and then you're passing it on to your kids if you don't use it at, I don't know, 32, 34. So make sure that you're looking at this tax plan. It starts at time of retirement. Make sure you're looking at those Roth conversions, because we see it all the time. It's like, I'm just going to ignore it. I don't want to deal with it. My kids will end up with my money. but then over a third of it goes to the government because no tax planning was done up front.
Yeah, that's what I was going to say. I was going to jump in there and say, yeah, with what is it estimated, 40 to 50 $1 billion, or is it $1 trillion? It's a ton of money, right? That is in retirement accounts that's got kind of a bullseye on it, right? I mean, when we got a $35 trillion debt, this deficit, I think it is 40 trillion, right? They're estimating 40 to 50 trillion dollars worth of retirement funds out there that haven't been taxed yet. So, you got to be a little concerned about that. If you've been letting these accounts grow and grow and grow and not dealing with the taxes, it's worthwhile to have that tax conversation. Tax efficiency, don't just let your kids deal with it. Get efficient now, right? Why not?
Yeah, I tell everyone, if you're not maxing out that 12% bracket, if you have some wiggle room there, to me that's an absolute no-brainer. Go in and do a Roth conversion, get that money into a Roth, growing tax-free for you in the future if you want to use it. Then it passes on to your kids, and they have another, as it stands right now, another 10 years of tax-free growth until they have to pull that money out and get into an after-tax account. So to me, if you're not maxing out the 12, that's an absolute no-brainer.
So I think that's the 5 risks. So I got a 6th one here. I'm actually going to throw at you guys real fast, Matt. We didn't kind of mention just basically the big risk multiplier. Well, I guess we kind of did, longevity, right? But I mean, if you think about the longer we're living, the more all this stuff gets amplified, right? Your market risk, your everything gets amplified because you're just around longer and you got to deal with more things coming at you. So you've got to I don't know. I mean, you've got to kind of really keep this in the forefront, right?
That's exactly right. All of these risks are correlated in some way. And just as you were saying, that 6 bonus risk, I'll give you one more, and that's cognitive decline. And that's something that as you're aging, longevity risk, that partners right up with that one. And then that puts everything else at risk, because who knows what you're going to do if you're not all there and you're trying to manage that yourself, the do-it-yourselfer.
Yeah.
That's where some costly mistakes can be made as well. So that's where it's nice to have an advisor or someone put in place to at least help you oversee all this.
Yeah, because if you're not careful, you end up like this. You made a lot of money, and then you want, and you didn't get enough sun. You spend all your time, looking at your returns. You got to enjoy those returns a little bit. Just pick it on you a little bit, Matt. But the point is, right, you got to get with somebody who can help you out. So if you need some help, as always, reach out to the guys. Make sure you're talking with a qualified professional. We'll have all the information in the show note descriptions for you guys to check out. You can also just go to retirementapproved.com. That's retirementapproved.com, which has been up in the corner of the show if you're watching us on YouTube. Don't forget to subscribe to us on Apple or Spotify or YouTube. Hit the little notification button there so you get new episodes when they come out. You can give them a call at 248-305-9911, 248-305-9911. If you're listening to this in audio form, or again, retirementapproved.com. Guys, thanks for hanging out and breaking it down and allowing me to poke a little bit of fun at you as well on this. But great stuff, though. Thanks for really breaking it down and highlighting us for us.
Yep, I'm going to make Matt go get a gym membership now after seeing that picture. So
and a suntan member. Get him outside. Go play some golf.
Will do.
Y'all have a great week. We'll see you next time here on Retirement Approved with Matt and Steve Paul. We'll see you next time.
Retirement Approved is brought to you by Richard W. Paul & Associates, an SEC-registered investment advisory firm. Throughout the presentation, we may generally discuss different financial vehicles. However, nothing we say should be construed as a recommendation to buy or sell any financial vehicle, nor should it be used to make decisions today about your investments or insurance. For full disclosures, check the show notes of today's episode.